AI is everywhere, and it's not changing how we live, but shaking up how we invest. Now, in this video, we're going to break down exactly what to do and what not to do as it pertains to investing in AI. Now, if you're looking to ride the wave that AI has been on lately, this checklist basically you can't afford to miss. It's a Bible of what to do and what not to do when you're looking at any AI company. So first things first, and probably what you're most interested in, we're going to go through the 5 things to do before investing in AI. Now, the first thing you want to consider is researching business models, not just buzzwords. And I know it feels like that's very hard to do, especially when everyone can just go AI, AI, AI in their earnings call and the stock goes boom. But we have to look at things from a little bit more pragmatic standpoint. What I mean by that is looking for tangible AI products or services that actually generate revenue. So you want to consider AI automation tools, large language models, APIs, things like that. You want to analyze how a company can add AI to its current business offerings to potentially give it a competitive advantage or expand margins. That one's a big one. A lot of companies right now are using AI to cut back on expenses, which conversely increase their margins, which is a huge potential advantage to a lot of these companies, especially in the labor field as well. You want to avoid the companies that say AI hype a lot in like pitch decks, but don't really say how they're going to turn it into making money. So essentially you want to kind of ask yourself, how does AI for this company drive revenue, reduce its costs, and improve efficiency? If it can't do those 3 things, you can't answer those 3 questions, probably look elsewhere. Just saying. Now, for your second bullet point of what to do before investing in AI, I want to say it's an old adage, and it probably is. You may be familiar with it and you may not. But when people are digging for gold, you want to be the one selling the shovels. You don't want to be the one digging for the gold, because you may never find the gold, but when there's a gold rush, there's plenty of people looking to buy the shovels. And that's the kind of plays you want to look for. You want to look for your pickaxe and your shovel plays. So what I personally look for is targeting infrastructure providers. For example, chip makers like NVIDIA and AMD. Those are your shovels, right? They're not necessarily the AI company, but they're the companies that need to exist for AI to exist, right? Another segment you could look out are cloud platforms. So you've got Microsoft and Amazon, right? Because they have AWS and Azure. And you could also look at, this one's a little bit of a far-fetched thought, but you could look at adjacent beneficiaries. So data center REITs. I found one called DLR. They're actually reporting earnings tomorrow. Or power management firms. Again, things that need to exist for AI to be successful. These tool makers will often profit even if AI, no matter what AI application wins, even if AI fails for a company, because guess what? They're still selling their chips to these companies that could flop. They're still selling the shovels to the people digging the gold, and they still make money. That's what I like to invest in as it pertains to the whole AI hype, is looking for those pickaxe and those shovel plays, the people who are selling the ability to make money on AI. And that's how I think a smart investor would look for. Now, that doesn't mean you can't get into those other companies that are directly AI companies, but having a little bit of that exposure may be a smarter way to still invest in AI without directly investing in AI in general, which we'll get into in our don'ts in a moment. Our third do is to evaluate profitability and cash flow in general. So many AI startups are going to start burning cash in order to chase scale. That's not really unexpected. In fact, it is expected for the market to see that with these AI companies to be burning money to try to adapt and try to gain market share as quickly as possible. As a result, if you can prioritize, so out of all the options you get, if you can prioritize looking at companies with positive free cash flow or sustainable burn rates, right? Because there is a rate in time where the burn rate, slowly they burn less and less and less and less cash, which eventually can lead towards profitability, obviously. Those are ones you should look at. You also want to look at gross margins in general and see if they're using their R&D expenditure efficiently. Are they investing in things and actually making money back, or are they just investing in things and losing it? Is the spending justified? Is the spending delivering ROI? Most importantly, as we talk about evaluating profitability and cash flow, we want to watch debt levels, right? So we're still technically in a rising rate environment, and that will probably cut here soon. But AI investments often require major capital, especially right now, right? The cost has not declined yet as we're in the first foray into AI. So things are expensive right now to even build into AI. I mean, look at NVIDIA. It's the largest company in the world, and they have so many orders coming through that they can't fill them all, really. That's how much hype there is around AI right now. So it is not cheap to have an AI company and run an AI company. So if rates stay high, that's a massive stranglehold on these companies. Now, conversely, if rates start to cut, that's going to allow these AI companies to breathe a bit, which could help their profitability and their cash flow, like we talked about here. The fourth do is you want to diversify across the entire AI ecosystem. So that doesn't mean putting all your eggs in one basket. You don't want to bet on one winner. You want to consider diversifying across verticals, meaning you could have AI healthcare exposure. You could have AI fintech exposure. You could have robotics exposure. You could have semiconductor exposure. You're still exposed to AI as a whole, right? It being eventually the next bastion of the next best thing in the world, but you're not putting all your eggs in one singular basket. So that allows you to invest in layers, right? You can invest in hardware, you can invest in software, data, end use applications. There's millions of ways that you can take your money and still invest it. Even if you want to put 100% of it in AI, right? All your money in AI, you could still pick different verticals and pick different layers that you could spread your money out on, and then still reap the benefits of what could be a huge move in AI in general without risking downside, which I think is really important. Now, mixing some large cap stability with small cap stability, I think, is what matters here a lot, because you'll see some outsized move on small cap companies as they become medium and large cap and they grow. But having some large cap and even some mega cap exposure prevents you from having some more downside, because that's what you want to do. You want to manage your risk as you're looking at these AI companies. So you don't really want to go full speculative, and you really want to mitigate single stock exposure in general, and focus on capturing the broader AI adoption in general. If you can capture that through moving through these different segments and diversifying across different verticals, that would probably be the best way to do it. Now, the one risk factor I want you to consider here, as we talk about this as a due point, you want to consider thematic ETFs for broader exposure if you're someone who can't be bothered to do all the research. With that being said, make sure you do your research on the ETF you're looking at, because there's a ton of ETFs out right now that can offer you AI exposure, but they could also go against what I just said here and have a ton of money in one stock and then, on other BS things, right? So that's something you could consider if you don't have a lot of time to do research on individual companies. But at that point, make sure you at least research the one ETF that you're investing all your money into. And the last due point is to track regulation and government trends. So obviously this is a brand new thing. We've seen things come out with the government in general as it pertains to AI and what is starting to be acceptable or not acceptable. And this regulation is evolving very quickly, especially with privacy laws. And that's not only here on stateside, but it's also in Europe and elsewhere. There's export restrictions, or there could be export restrictions, which could impact margins, could impact your R&D timeline. So if companies research into things, that could obviously impact those timelines, or in general, international growth. Growth across the world could be impacted by these restrictions, because it's going to be hard to move into new markets if there are certain restrictions that the company may not see in market A that they have to abide by in market B. In general, you want to monitor all these AI laws as they come down the pike. If you can do it, consider companies with strong compliance practices. Some companies, it's not really, how do I say this? It's not important enough yet where companies are strongly complying and like, oh, we're going to do it right away, because this isn't as busy. Like, we're not seeing regulation come down every single day. But if you want to consider the companies that seem responsive, I guess is what I'm trying to say here. And the only other thing you want to consider are potential regulatory tailwinds, which could actually favor some firms over others. So as we're talking about regulation in general, these firms that seem compliant and seem to work much quicker than these other firms can steal market share as a result. So think of it this way. If there's a new privacy policy implemented and company A gets in right away and they abide by the law or whatever, and company B is lagging on it, company A can steal market share from company B because now they can operate because they're following the law, whereas company B cannot. So there could be an opportunity there where there is a tailwind where certain companies that are quicker to react to these restrictions, I want to say, can actually steal market share from others. So that's something that could benefit you as an AI investor. Now, those were the 5 things to do as it pertains to AI investing. And these are the 5 things to do not do, to watch out, avoid for, etc. This one's pretty obvious, and you guys probably know this watching this, but you don't want to chase AI hype cycles blindly, right? You're going to see times where AI companies are going to moon out of the blue. It's going to go up 70%. And you're going to go, oh, I should invest in that. Slow down, okay? I would avoid, me personally, buying AI companies solely based on news, Reddit hype, or especially if it's on CNBC. If it's on CNBC, MSNBC, and it's been pumped, turn the other way and run. Do not touch. You may work out at some point, but at least near term, do not touch. Especially watch out for stocks that get a big spike, so 50, 100%, 200% after a vague AI announcement or AI integration. Just because a company says they're going to start doing AI or says they're doing some sort of AI announcement doesn't necessarily mean that makes them a good investment or even an AI company. What if I ran a hot dog company and I just said, oh, we're implementing AI and the stock spikes and you don't know anything, you just buy the ticker anyway? And that seems a little stupid because I make hot dogs. What does AI pertain to hot dogs, right? It just... Be careful, because there's some companies already doing this, especially if you trade OTCs. You see this all the time. But there are some companies doing some shady things out there right now, trying to catch the wave of AI at the moment. So if you do want to look at some of these hype companies when they present those opportunities, when they get a spike, if anything, take a second, slow down, and you can look at their fundamentals, see if the sales or the users there are profits actually growing, or is it simply hot air? Because not saying they're all bad spikes, right? There could be some legitimate spikes where it's justified. But if you do decide to chase hype, I would highly recommend you consider looking at those fundamentals if sales are there, if users are growing, or profits actually growing before jumping into an AI hype trade. Second thing you should not do or avoid as it pertains to trading in AI or AI companies is to not ignore value multiples. Now, it's very obvious that these AI companies are evaluated very highly, a lot of them, a little too highly, which may not be the worst thing because these companies are the future, right? These multiples that they have are betting on the future expansion, the future growth of said companies. So as a result, the company gets its evaluation from the future proposed growth that it could bring. However, if that growth slows or the sentiment shifts, these overvalued AI stocks will plummet. And you may wake up one day with a very red trade on your hands in general. So if you do want to be a little bit more safe with investing in AI, perhaps consider using a PE ratio or a PEG ratio and comparing it to other AI peers to kind of make yourself feel a little bit more comfortable before considering investing in AI or a specific AI company, I guess I should say. In general, companies that are trading basically 50x their revenue are extremely fragile. They're out there. They're still going up, but they're very fragile. And it just takes one news drop, one offering, a shelf out, whatever, to drop them hard because they're so inflated. So be very, very, very mindful of that. A great example of this, it wasn't AI, but during COVID, all those work-at-home companies, Teladoc and Peloton come to mind right now that were through the sky. They're now trading single digits. Those companies will fall very, very, very hard if anything changes in the future. If what got their value changes, they're going to drop, and they're going to drop hard. So you want to keep that in the back of your head. A good way to look at this, and a good way to keep this in the back of your head, ask yourself before you purchase an AI-based company, would I still buy this if it was 20% more expensive tomorrow than today? And if the answer is still yes, then maybe you can consider a trade, at least in my book, with a specific AI company with a very high evaluation. I'll make that abundantly clear. Third thing that you should not do when investing in AI is concentrating in one or two names. So if you're overweight in your portfolio with any of the AI darlings, especially like NVIDIA, I'm sure that's extremely tempting, right? That thing is the largest company in the world, keeps going up, etc. But it could lead to excessive drawdown risk for your overall portfolio, right? Even these great companies that seem to consistently perform really, really, really well can disappoint. even temporarily. And as a result, you want to consider spreading your exposure, like we talked about in the do section. There's other ways where you could still be exposed to AI, just kind of spread out your eggs a little bit more. You kind of spread out your money a bit more. So diversifying outside of the obvious mega caps like Nvidia and Microsoft can help you reduce your risk and actually can help juice up your profits more too, because you're getting into riskier names that are maybe mid cap or large cap, or they're in a different sector completely but still use AI. So this actually could be a beneficial thing for you instead of putting all your eggs just in Nvidia or just in Microsoft, because there will be times where, yes, it could go up a lot, but it could also draw down excessively as well. And in general, staying too strongly concentrated in one thing could be a really bad time. In going back to the ETF idea earlier, you may think you may be safe investing in an ETF that focuses on AI, but you want to be aware of index crowding, because some of these ETFs may already be overexposed. SPY, you could even argue, is overexposed because of the Mag 6 and Mag 7, right? What is it, 20-30% of SPY's value is drawn from 7 companies. That's insane. That's absurd. It might be 20%, 20-30%, something like that. Still, a large percentage of SPY is drawn from 7 companies. So even investing in just the SPY can leave you, theoretically, overexposed to AI in that realm if you see all 7 companies or all the Mag 7 are investing in AI, mainly because of the fact that it's so overexposed. What I would recommend you consider is to set exposure limits. So me personally, I don't have more than 5% of a portfolio in any one position. Pretty simple. If I like really love a company, then I might change up my exposure and lower equity exposure, increase options exposure. So for example, do like 3 equity, 2% options. Unless it's like an ultra amazing trade, maybe I'll bump it to 6 or 7%. And even then I watch it like a hawk. But setting that single stock exposure to 5%, it doesn't mean you're missing out, because even if there's a big move, there can also be other big moves in other names that you now have exposure to because you freed up your money. So I think a limited mindset that a lot of traders have is, I can get really concentrated in one name or 2 names, and I'm so confident it's going to move, and when it moves, I'm going to make a lot of money. Why not be confident in the realm in which that company can operate and diversify a bit, because you could now not only reduce your risk, but actually increase how much you can make, because now you're exposed to other areas. If you believe in AI and you want to invest in AI, now you're invested in all these other areas of AI, not just the one sole thing. And I think a lot of people don't grasp that concept, where you can actually make more money while also reducing your risk. And I am all about that when it comes to trading. So that's something to definitely consider as it pertains to something not to do when you're investing in AI. Now, the fourth do not do is don't assume that AI is basically a guaranteed tailwind. As a result, some companies will fail to commercialize AI, even after sinking a ton of money into R&D. And as a result, they can misallocate capital or even not execute. There could be execution risk. So just because a company puts money into AI doesn't mean they're going to make money with AI. And I think that's something that a lot of people aren't thinking about right now in general. As AI adoption increases, operational costs also can increase before showing any returns in general, right? So as AI grows and grows and grows, it may cost more money to keep up running AI. I mean, you can even look at all these AI companies like ChatGPT, for example. They had to lower the amount, this was a few months ago or whatever, they had to lower the amount of free users accessing the image generation part of it because it was using too much money or too much electricity or whatever, and they had to change up their payment structure, whatever, because it was more expensive to run it that way. So they had to limit it and give more perks to the people paying. Conversely, the last thing as it pertains to this particular category is dependency on third-party models. So companies that have structured their AI business around, for example, use ChatGPT again, OpenAI, may limit its defensibility. So this does one of 2 things. One, it lowers the barrier to entry. Anyone can get in, right? If OpenAI has open APIs that companies can just use to implement their ChatGPT program on their platform, then anyone can do it. They just got to pay the money for it. So that makes a lower barrier to entry. And secondly, it opens you up to a new risk, because what if OpenAI goes down? What if you buy an AI company and their whole business is centered around OpenAI? And if OpenAI servers go down or whatever happens, guess what? Not only is OpenAI not making money, but this smaller company, because it will be smaller than OpenAI, is going to get shafted hard because now they can't even run their business. So that is a massive risk as it pertains to assuming that AI can be a massive tailwind. That's why I like the companies that are including AI or have their own AI platform, where it's not the end all be all. It's not the whole company. It's something that sweetens the pot. It's something that makes a established business better. That's what I like about AI, or the companies I look for as it pertains to AI. And in general, your last do not is don't forget macro sensitivity. So AI, as most of you know, is going to require enormous amount of energy and computating resources. So as a result, you're going to want to keep an eye on energy prices as a whole. That money's got to come from somewhere. We've seen nuclear energy been very hot lately in general because that seems as the next bastion for AI. Again, another AI adjacent thing you can invest in are these nuke companies. The other thing you want to keep in the back of your head, which I'm not as worried about, obviously interest rates. So as they rise, as they lower, whatever, as those rates rise, which again, we're technically in I would call it a plateauing environment because we haven't risen rates now in a few months, and it looks like we're going to cut soon. But that can basically put a stranglehold on a lot of these smaller companies that still haven't turned a profit. And that just goes in general, not only AI. So that's something you want to be aware of from a macro standpoint. And last thing is general geopolitical risk. If there's a ship export ban, that's like the big one lately that we've been seeing. If like NVIDIA having certain chips shipped to China, not to China, whatever, that can disrupt entire supply chains. If we have this geopolitical farce of people trading, not trading, whatever, that can be very detrimental if you're investing in AI companies. So something else to consider when you are trading in AI companies. So before you chase the AI rocket to the moon, you want to make sure you're prepared. The space is moving really quickly, but at the end of the day, the fundamentals will still matter. And I think that's the one main thing you could take away from this conversation. So as a result, I think the most important thing, along with that, is to be strategic, be skeptical, but most of all, stay informed. If there's one other, like just looking at all these points that we talked about, being informed is actually like the biggest driver here. That way, ultimately, you know how to stay ahead of the curve while keeping your portfolio grounded. So you're not overexposing any which way and you're just aware of what's going on. But now I want to hear your thoughts. So if you agree or disagree with these points, as it pertains to AI, let me know down in the comments below. Sound off, and don't forget to like and subscribe if you haven't already. We will see you in the next video.